Hey everyone. Sometimes it feels like you need a PhD in finance just to figure out where to put your money, right? It can be super overwhelming. Well, you are definitely not alone. Today, we're going to cut through all that noise and all that jargon to really break down one of the most popular tools for building wealth, the mutual fund. So let's jump right in.
Does this question look familiar to you? I bet it does. It's probably the #1 question people ask. And you know what? It gets right to the heart of the problem. See, that question is all about the investment, not the investor. And today, we're going to flip that whole idea on its head.
Okay, so before we can even begin to find the best investment for you, we first have to understand the fundamental choice that every single investor has to make.
So you really have two paths you can take. On one hand, you can go it alone, the whole do-it-yourself route. And that means you're the one doing all the homework, picking the stocks, handling the paperwork, tracking every little thing. It's a lot. Or on the other hand, you can get professional help. This is where you basically hand over the heavy lifting to a team of experts. And that second path, well, that's exactly where mutual funds come into the picture. So what on earth are they, really? At its very core, a mutual fund is a vehicle. Seriously, think of it like a bus. You've got a whole bunch of people, and they're all trying to get to the same general destination. So instead of driving themselves, they all chip in some money to hire a professional driver, that's your fund manager, who knows the best and safest routes to get them where they want to go financially. Now, this right here is such a key shift in how you should think about this. A mutual fund isn't the final destination, it's the way you travel. It's kind of like a financial potluck dinner. Everyone brings a little something to the table. That's the money. And a professional chef, your fund manager, takes all those ingredients and creates this big, diversified meal of stocks, bonds, and other assets for everyone to share.
Okay, so how does this financial potluck actually work in practice? Let's break it down, step by step.
It's a pretty simple process, really. Just 4 main stages. First up, investors like you and me, we all pool our money together. Step 2, a professional fund manager takes that big pool of cash and invests it. 3, they use that money to build a diversified portfolio of all kinds of things, stocks, bonds, you name it, all based on the fund's specific goal. And finally, number 4, any profits or returns made by that portfolio get shared among all the investors. Simple as that. Now, when you put your money in, you don't actually own the individual stocks directly. Instead, what you're buying are units. Think of a unit as your personal slice of the entire portfolio pie. And the price for one single unit? That's called the net asset value, or NAV for short. It's calculated every single day, so you always know exactly what your share of the pie is worth. But here's the thing, and it's a big one. Not all mutual funds are created equal. Just like you wouldn't take a city bus to go off-roading in the mountains, you've got to pick the right fund for your own unique financial journey. This table here really lays it out. Different funds are designed for totally different goals. So let's say you're saving for retirement way down the road. A growth-focused equity fund might make sense. But what if you're looking for a more steady, regular income right now? Well then, a debt fund might be a much better fit for you. See? It's all about matching the investment to your personal want. And you know, some funds even try to give you the best of both worlds. A hybrid fund, for instance, mixes different kinds of assets. It'll have some stocks for that potential growth and some bonds for stability. It's like a prepackaged, balanced strategy all in one.
All right, so this all sounds pretty good, doesn't it? But what's the catch? Because like any investment out there, mutual funds have their good sides and their not so good sides. Let's be real and take a look at both.
Okay, on the pro side, what are you getting for your money? Well, first, and this is a biggie, you get professional management. We're talking about experts who do this stuff day in and day out. You also get instant diversification for your portfolio, even if you only have a little bit of money to start with. And because the fund is buying stocks in huge volumes, you benefit from economies of scale, which means lower trading costs for you. Plus, most funds have great liquidity, which just means it's easy to get your money out when you need it.
Now for the flip side, what are you giving up? Well, you do give up some control. You can't just call up the manager and ask them to sell a stock you don't like. You're on the same bus as everyone else. You also don't have direct control over the fund's costs, though those are heavily regulated. And this is the most important one. There are absolutely no guaranteed returns. The value of your investment can go down just as it can go up.
Which brings us full circle, right back to the beginning. Before you even think about the what, which specific fund to pick, you have to be crystal clear on your why. Why are you even investing in the first place? Is it for a down payment on a house in 5 years, retirement in 30? Your personal goals are what drive every single decision.
So, we've covered the what, the how, the pros and the cons. We've given you the whole framework to understand this really powerful investment tool. Now, the The only question left is the one that only you can answer. What's your why?